Imagine selling a building you've owned for years, right? An investment property, it's gone way up in value. You've got this fantastic return, and then, bam, you see the capital gains tax bill staring you down.
Ouch, yeah.
It feels like, a huge slice of your profit just vanishes. Gone.
Before you even get your hands on it.
Exactly. But what if? What if you could just pause that tax, put it on hold, keep that money working, reinvest it, maybe even see that new growth happen tax-free?
Now you're talking, that's the potential, isn't it?
It's not just a dream, right?
Right.
It's what certain tax strategies here in the U.S. promise for real estate investors.
It absolutely is.
So today, we're diving deep. We're looking at two big ones. The old guard, the 1031 exchange.
Yeah.
Been around forever.
Yep, heavyweight champ.
And then the newer player, the Opportunity Zone program. Much more recent.
That's right. And we're working from this pile of material you pulled together. Articles, IRS docs, expert takes, real nitty-gritty stuff. When Opportunity Zones, or OZs, first came out with the 2017 Tax Cuts and Jobs Act, oh man, the buzz.
Huge buzz.
Especially for real estate folks who knew 1031s inside out. People are asking, will OZs fit alongside 1031s?
Or even replace them.
Exactly. Could this be the new 1031?
Yeah.
But as we've dug into the rules, looked at how they actually work, the picture's gotten, a lot clearer. They're really different tools.
Different jobs.
Different jobs, different aims. Although, yes, there are some very specific, limited ways they might actually connect.
Okay, so that's our mission for this deep dive. Let's break down exactly what these two things are. The 1031 exchange, the OZ program.
Yep.
Get into the real nuts and bolts, the rules. What are the pros, the cons?
Lay it all out.
Put them side by side. Where do they really differ?
Yeah.
And then, tackle that big question. Can you actually use them together? How?
And we're sticking just to what's in these sources, mapping it out based on that.
No outside info, just the facts from the material. Okay, let's start with the veteran, 1031.
Absolutely. Section 131, it's deeply woven into U.S. real estate investment, and for good reason.
Okay, let's unpack the 1031 exchange.
Yeah.
What's its core purpose? Like, what problem does it solve for an investor?
Basically, it lets you sell one investment property or business property.
Okay.
And then reinvest the money you made, the proceeds, into another similar or like kind property.
Right.
And here's the kicker. You get to defer the capital gains tax you'd normally owe on that sale.
Defer, that's the key word, isn't it?
It is. It's not tax-free. Not at this point. You're just postponing it.
Kicking the can down the road.
Pretty much. The tax liability gets baked into the basis of the new property. It just sits there waiting until you eventually sell that property in a way that is taxable.
So it keeps more of your money working for you right now instead of going to Uncle Sam immediately.
Exactly. More capital compounding.
And who gets to use this? Is it just for, big real estate tycoons?
Oh, no, it's pretty broad. Our sources say individuals, C-Corp, S-Corp, partnerships, LLCs, trusts, basically any tax-paying entity.
So if I have a rental house or a small partnership owns an office building.
You could potentially qualify, yeah, as long as it's held for investment or used in a trade or business.
You said it's a veteran, almost 100 years old. How did something like this even get started? What was the thinking?
It's actually a pretty interesting slice of tax history. It goes way back to 1921, Section 202 back then.
Wow.
The original logic was, kind of simple. If you just swapped one farm for another farm, say, with no cash involved.
Just a direct trade.
Right. It didn't really feel like you'd cashed out. There wasn't that clear moment of money in your pocket that usually triggers tax.
Makes sense.
So the idea was, hey, if you're just continuing your investment in a similar kind of property, let's defer the tax until you actually sell for cash. It was about this continuity of investment.
Okay, so it started simple, maybe just direct swaps. I imagine it got more complicated over the years.
Oh, definitely. For a long time, simultaneous swaps were the main way. But the big game changer was a court case in 1979, the Starker decision.
Starker, what did that do?
It basically said, hey, a delayed exchange is okay too, where you sell your property first and get the replacement property later.
So not simultaneous.
Right. But the problem was, in the Starker case, they had like a 5-year window.
5 years.
Yeah, the IRS and Congress looked at and said, whoa, no way, that's too long, too loose.
And that's where those super strict timelines came from. The 45 days, the 180 days.
Bingo. The 1984 Tax Reform Act slammed those down in direct response to Starker, created the deadlines we know today, non-negotiable.
Tightened it right up.
Exactly. Then in 91, Treasury regulations came out, added more structure, introduced these safe harbors, and crucially, spelled out the role of the qualified intermediary, the QI.
We'll definitely get to the QI.
And then, more recently, the 2017 Tax Act made that big change. Now 1031s are only for real property. No more personal property exchanges.
Right. And Pennsylvania was the last state to get fully on board.
Yeah, 2023 finally lined up their state rules with the federal ones. So yeah, long evolution.
Okay, history covered. Let's get into the rules now. The absolute must-knows for anyone thinking about a 1031. First big one.
Yeah.
Like-kind property. What does that really mean for real estate? It's not identical, right?
No, that's the number one misconception. For real estate, like-kind is surprisingly broad. The sources stress it's about the nature or character of the property.
Nature or character.
Yeah.
Not like condition or quality.
Exactly. It just has to be real property held for investment or used productively in a trade or business.
Well,
so you could trade, say, undeveloped land you're holding for appreciation for a commercial office building you plan to rent out.
Okay.
Or you could sell a single-family rental house and buy an apartment complex.
So a duplex for a strip mall could work if I intend to hold the strip mall for investment.
Generally, yeah. That fits the like-kind standard. But there are key things that are not like-kind.
Like what?
Your main home, your primary residence. That's personal use. Doesn't count.
Okay, no house swaps.
Right. A vacation home you use a lot yourself. Probably out, too, unless you can really, really show strong investment characteristics, lots of rental income, claiming depreciation, minimal personal use days. It's a high bar.
Gotcha.
Also, U.S. property can't be swapped for foreign property. They're not like-kind.
U.S. for U.S. only.
Correct. And crucially, since 2017, real property is never like-kind to personal property. You can't swap a building for a fleet of trucks anymore. That's gone.
So the intent is huge here. Why you're holding the property matters just as much as what it is.
Absolutely critical. The IRS looks at the facts and circumstances. Are you getting rent? Claiming depreciation. How long did you hold it? Did you list it for rent or just try to flip it fast?
But so house flippers generally can't use 1031s?
Typically not. That property is usually seen as inventory held primarily for sale, not held for investment. You need that longer-term investment or business use mindset.
Makes sense. Okay, the timelines. The 45-day clock, the 180-day clock. This sounds like where things get really intense.
This is where the pressure is, definitely. And these deadlines are like ironclad, set by Congress. No extensions unless there's a major presidentially declared disaster.
Okay, first clock. 45 days.
Right. The 45-day identification period. It starts the day you close the sale on your old property, the relinquished property.
Day zero.
Day zero. From that day, you have exactly 45 calendar days, including weekends and holidays, to formally identify potential replacement properties.
How formal? Like, just tell my agent.
No, more formal than that. It has to be in writing. You have to sign it, and you need to deliver it to someone involved in the exchange other than your agent.
Who's not my agent?
Typically, your qualified intermediary. That's the most common way. Or sometimes the seller of the replacement property, but not someone considered your agent, like your realtor or lawyer or accountant involved in the deal within the last 2 years.
Okay. And the identification itself?
Needs to be specific, unambiguous, like the street address or a legal description or maybe the unit number if it's a condo. Clearly point to the property.
So sell on day zero. By midnight, on day 45, that signed written list has to be in the QI's hands. What if I miss it by 1 day, day 46?
The whole exchange is dead. Kaput.
Yeah.
Your entire gain from the sale becomes taxable in the year you sold. It's that strict.
Yikes. Okay, 45 days to identify. What's the second clock?
The 180-day exchange period. This clock also starts on day zero, the day you sell your old property.
Same start date.
Same start date. You have a total of 180 calendar days from that sale date to actually close on and receive the replacement property, to finish the whole exchange.
So 6 months, roughly.
Roughly. But there's a catch. It's 180 days or the due date of your tax return for the year you sold the property, including extensions, whichever comes earlier.
Okay. So if I sell late in the year, my 180 days might end before my normal April 15th tax deadline.
Could happen, yes. Or if you sell early in the year, the 180 days might go past April 15th, meaning you'd have to file an extension for your tax return to get the full 180 days to complete the exchange.
Got it. And the 45-day clock is running inside the 180-day clock.
Exactly. They run concurrently. Identify by day 45, close by day 180, or tax day.
That clarifies it. Now, within that 45-day identification window, how many properties can I actually put on my list? Are there limits?
Yes, there are rules to prevent you from just listing everything under the sun. 3 main options.
Okay.
Most common is the 3-property rule. You can identify up to 3 properties, doesn't matter what their value is, Nice and flexible.
3 properties, any value. Simple enough.
Then there's the 200% rule. You can identify more than 3 properties, but the total combined fair market value of all the properties on your list can't be more than double 200% the value of the property you sold.
Useful if maybe I'm buying several smaller places.
Exactly. If you sold a $1 property, you could identify, say, 5 properties as long as their total value is $2 or less.
Okay. And the third one, it sounds less common.
It is. The 95% rule. This kicks in if you identify more than 3 properties and their total value exceeds that 200% limit. If you do that, you then must actually acquire replacement properties that make up at least 95% of the total value of everything you identified.
Whoa. So I basically have to buy almost everything on my list.
Pretty much. That's why, as the sources say, it's rarely used. Way too risky. You'd have to be incredibly confident you could close on almost all of them.
Yeah, sticking to the 3 property or 200% rule seems much safer. You mentioned reverse exchanges earlier too, where you buy first. Does that have different ID rules?
It does. A reverse exchange is definitely more complex. You need an exchange accommodation title holder, or ETOL is basically a friendly third party, to temporarily park either the new property you want to buy or the old one you need to sell.
All right.
In that setup, the rule is you have to identify the property you plan to sell, your old one, within 45 days after the ET takes title to the new replacement property. There's specific IRS guidance, Reverend Proc 2037, that provides a safe harbor structure for these.
Sounds like something needing expert guidance for sure. Let's stick with the standard deferred exchange. You mentioned the qualified intermediary, the QI, several times. Their role sounds absolutely vital. What exactly do they do? Why are they so important?
The QI is the linchpin of most deferred exchanges. Those 1991 regulations basically created the QI role as a safe harbor to make these delayed swaps work without violating tax rules about getting your hands on the money.
Rules about constructive receipt.
Exactly. Constructive receipt means even if you don't physically have the cash, if you have control over it or access to it, the IRS treats it as if you received it. That would blow up the 1031.
So the QI steps in to prevent that.
Precisely. They act as a neutral third party. When you sell your old property, the money doesn't go to you. It goes directly from the buyer into an escrow account held by the QI.
Okay. They hold the cash hostage, basically.
In a good way. Hostage from you, so the IRS doesn't consider you to have received it.
Yeah.
You can't access those funds directly during the exchange period.
Makes sense.
Then, when you're ready to buy the replacement property, the QI takes those funds they've been holding and pays the seller of the new property, transferring the title to you, all within that 180-day window.
So they handle the money flows start to finish.
Yes, and more. A good QI also helps guide you through the rules, keeps you on track with deadlines, prepares the specific exchange documents, and coordinates the closings.
Seems crucial to pick a good one.
Absolutely. The sources really stress this. While the rules provide safety measures like requiring funds in qualified escrows or trusts, and even letting you earn interest on the held funds, things can go wrong.
Like what?
There have been cases, sadly, where QIs failed, maybe misused funds, or went bankrupt. If that happens and you can't complete the exchange on time because the money's gone, you're stuck paying the tax.
Oof. So vet your QI carefully. And I can't just have my brother do it.
Right. You can't be your own QI, and you can't use someone who's been your agent, like your realtor, lawyer, accountant, investment banker, in the 2 years before the exchange starts. Needs to be independent.
Got it. Okay, sold the property, identify the new one, QI is holding the cash. Now, reinvestment. How much do I actually have to put into the new property to get the full deferral? Does it have to be every penny?
To get full tax deferral, yes, you essentially need to reinvest everything. The rule is the value of the replacement property or properties you buy must be equal to or greater than the value of the property you sold.
Value meaning purchase price.
Purchase price, yes, but it also includes any debt. You need to replace both the equity and any debt you paid off when you sold the old property.
Okay, example time. I sell a building for $2 million, no mortgage. I need to buy a new place worth at least $2 million.
Correct.
What if I sold a $2 million building that had a $500K mortgage on it?
Then you need to buy a replacement property worth at least $2 million total. And importantly, you generally need to acquire that new property with at least $500K in new debt, or put in $500K of your own cash on top of the exchange proceeds to fully replace the debt you paid off.
What if I don't? What if I buy the $2 an hour property but only get a $300K mortgage this time?
Then you have what's called boot.
Boot? Heard that term. What is it exactly?
Boot is anything you receive in the exchange that is not like-kind property. The most common types are cash boot, maybe the QI gives you some leftover cash, or mortgage boot, like in your example.
So reducing my debt is considered receiving something.
Yes, reducing your overall debt load through the exchange without putting in offsetting cash is treated like receiving cash. It's called mortgage boot or debt relief boot. So in your case, paying off a $500 K mortgage and only taking on a $300 K mortgage means you have $200 Ks of mortgage boot unless you added $200 of fresh cash to the purchase.
And boot is taxable.
Boot is taxable, yes, up to the amount of your total capital gain. If you sell for $600K and only buy for $500, that $100 K difference is cash boot and it's taxed. The key to full deferral is acquiring equal or greater value and equal or greater bet, or offsetting debt reduction with cash. No boot.
Got it. Avoid the boot. Okay, we've hit the main rules. Let's talk benefits. Why go through all this hassle? What are the big advantages of a 1031?
The number one advantage, the headline, is that indefinite tax deferral.
Indefinite.
As long as you keep rolling the investment over through subsequent exchanges, you keep pushing that tax liability further and further into the future. This lets your entire investment grow, not just the after-tax amount. It's huge for building wealth over time.
Compounding on the pre-tax money.
Exactly. And here's a really big one, especially for estate planning. If you hold that final replacement property until you pass away, your heirs generally receive it with what's called a stepped-up basis. Their basis becomes the fair market value at the time of your death, meaning all that deferred capital gain from all those previous exchanges just vanishes. Poof. It's never taxed.
Wait, seriously? The tax just disappears if you hold it till death?
That's the potential under current law, yes. It's a massive estate planning benefit.
Wow. Okay, that alone is huge. What else?
Well, you can sometimes net different types of boot against each other under specific rules. You have great geographic flexibility. You can exchange property anywhere in the U.S. for property anywhere else in the U.S.
Swap Florida for Montana.
Yep. And you can buy different types of real estate, land, apartments, commercial, whatever fits the like kind and investment intent rules. You don't have to do major construction or anything on the new property.
You can buy something already stable and running.
Right. It also defers depreciation recapture, which is tax on the depreciation you previously deducted. And generally, you keep direct ownership and control of the specific property, unlike investing in, say, a large fund.
That's a powerful list of reasons why it's so popular. But nothing's perfect. What are the downsides, the limitations we need to keep in mind?
Well, that reinvestment requirement is a big one for some. To get the full deferral, you lock up the entire value. You can't easily pull cash out tax-free. You're trading one asset for another.
Less liquidity.
Definitely. It's also limited only to real property held for investment or business. Can't use it for your stock portfolio or your car collection or the sale of your operating business itself.
Real estate only.
Real estate only. Those strict timelines, 45 days, 180 days, they're brutal. Miss one, and the whole thing collapses. Major stress factor.
Yeah, I can imagine.
You have to use a QI for most exchanges, which means giving up control of your funds for up to 6 months. That requires trust and, as we said, careful vetting of the QI.
Okay, that gives us a really solid understanding of the 1031 exchange. The history, the rules, the good, the bad. It's a powerful tool for swapping real estate assets and deferring that tax, potentially forever.
Absolutely. A cornerstone strategy.
Now let's switch gears. Let's talk about the newer kid on the block, opportunity zones. OZ came out of the 2017 tax law. What's the big idea behind OZs? What are they trying to achieve?
Opportunity zones have a very different starting point. It's really a specific policy initiative under Internal Revenue Code sections 1400Z1 and 1400Z2. The goal was, explicitly, to spur economic development and create jobs in designated low-income communities.
So targeted investment, not just anywhere.
Exactly. Each state governor nominated specific low-income census tracts based on certain criteria, plus some adjacent tracts. The IRS then certified these lists, so you have about, 700 or so designated zones across the country.
Okay, specific locations. How does an investor actually get involved? How do you access the tax benefits?
The whole system works through investing in something called a Qualified Opportunity Fund, or QOF.
QOF.
Okay, that's the vehicle. You get the tax benefits by investing eligible capital gains into one of these QOFs.
And what is a QOF? Is it like a mutual fund?
Sort of, but specifically for OZ investments. It's an entity set up as a U.S. partnership or a corporation. Importantly, our sources note it generally can't be a disregarded entity like a single-member LLC unless that LLC chooses to be taxed as a corporation or partnership.
Okay, partnership or corporation structure. And what does the QOF invest in?
It has to hold at least 90% of its assets in what's called Qualified Opportunity Zone property, or QOZP.
QOZP, is that just buildings in the zone?
It can be. QOZP includes tangible business property located and used in the zone, like buildings or equipment, but it can also be stock in a QOZ business or an interest in a QOZ partnership operating within the zone. So it could be direct real estate, or it could be investing in businesses in the zone. The investment goes into the fund, which then puts the money to work in the zone.
Got it. Okay, let's talk carrots. The tax benefits. Why would someone invest their capital gains here instead of just paying the tax?
There are potentially 3 benefits, although one of them is kind of expired now for new money.
Okay, let's hear them. Benefit number 1.
First is temporary deferral of prior capital gains, and this is a huge difference from 1031.
How so?
You can defer gains from selling any kind of appreciated asset, not just real estate.
Wait, any asset? Like I sell some Bitcoin or my startup stock, have a big gain, I can roll that gain into an OZ fund.
That's exactly right. Stocks, bonds, art, a business, collectibles, or real estate. If you have a capital gain, you can potentially defer it by investing that gain amount into a QOF.
When do I have to invest it?
Within 180 days of realizing that gain. So sell the stock, start the 180-day clock to invest the gain in a QOF.
Wow, okay. That opens it up to way more people than just real estate investors.
It really does. Big potential pool. But, and this is critical, the deferral is only temporary.
Temporary. How temporary?
Yeah.
Not indefinite like 1031.
Nope. That deferred gain. It becomes taxable on the date you sell your QOF investment or on December 31st, 2026, whichever happens first.
December 31st, 2026. That's a hard stop.
Hard stop. That original tax bill is coming due then no matter what, unless you sell out earlier.
Yeah.
Very different from 1031's potential indefinite deferral.
Okay, big difference right there. What was the second benefit, the one that's mostly historical now?
Right, that was a partial exclusion of that deferred gain. It worked as a step up in the basis of your QOF investment.
How did that work?
If you held your QOF investment for 5 years, you got a 10% basis step up on the deferred gain. So slightly less tax due in 2026. If you held it for 7 years, you got an extra 5% for a total 15% step up.
But there were deadlines to get those.
Yes, strict ones. For the 7-year 15% benefit, you had to invest by the end of 2019. For the 5-year 10% benefit, you had to invest by the end of 2021.
And since we're past 2021.
Exactly. Our sources are clear. These basis step-up benefits are no longer available for anyone making a new OZ investment today. They were part of the initial pitch, but that window has closed.
Okay, crucial point for anyone listening now. So temporary deferral until 2026 is still alive. What's the third benefit? You said this might be the biggest draw now.
This is the one generating the most excitement for long-term investors now. The potential exclusion of new gains.
New gains, meaning the profit on the OZ investment itself.
Exactly. If you invest in a QOF and hold that investment for at least 10 years.
10 years, okay.
Any capital gain from the appreciation of your QOF investment is potentially 100% tax-free when you sell or exchange it.
Whoa. Tax-free growth.
Tax-free growth on the investment within the fund. This potential lasts until the program currently sunsets, which is December 31st, 2047.
So let's be clear. The original gain I deferred is still taxed by 2026. But if the OZ project does really well over 10 plus years, the profit I make on that OZ investment itself could be completely tax-free.
That is the major potential upside, yes. A powerful incentive for patient capital going into these designated zones.
Okay, temporary deferral on the old gain. Tax-free growth on the new investment after 10 years. Sounds pretty good, but I sense some buts coming. What are the catches, the requirements?
Oh, there are definitely significant requirements, and this is where OZs differ dramatically from just buying a rental property in a 1031. The big one is the substantial improvement or original use rule.
Substantial improvements.
That
Sounds expensive. What does it mean?
It means if the QOF invests in tangible property, like a building within the zone, that property generally has to be either original use, meaning the QOF is the first one putting it to use in the zone, think new construction.
Okay, build new.
Or if it's an existing building, the QOF has to substantially improve it.
And substantially improve means?
It means the QOF has to spend at least as much money on improving the building as the QOF paid for the building itself. And here's a key detail. You exclude the value of the land when calculating how much you need to spend on improvements.
Okay, walk me through that. QOF buys an old warehouse in an OZ for $1 million. Land's worth $200K, building's worth $800.
That's right.
To substantially improve it, the QOF has to spend at least $800,000 on fixing up that warehouse.
That's it, exactly. Within 30 months of buying it.
30 months. So basically, you have to double the building's value through renovations or redevelopment.
Pretty much. As the sources say, this rule really channels OZ investments towards new construction or major gut rehabs. You generally can't just buy a nice, stable, already rented apartment building in an OZ, put it in a QOF, and call it a day, unless you're planning a massive overhaul.
So no turnkey properties unless you're gutting them. What about raw land?
Raw land can qualify, but only if it's actively used in a trade or business within the zone, not just held passively hoping it goes up in value.
This really forces a development focus, doesn't it? Very different from buying a stabilized asset in a 1031.
Totally different strategy, and that inherently brings development risk.
Right. Construction delays, cost overruns.
Permitting nightmares, maybe the demand isn't there when you finish. And remember, these are designated low-income areas. They might be riskier, less proven markets than where you might do a typical 1031.
Okay, substantial improvement is a huge hurdle. What about the timing for getting your initial investment in? Is that strict like 1031?
Yes, you still have that 180-day window, but remember, it starts from the day you realize the capital gain from selling whatever asset it was, stocks, business, real estate. Sell your Apple stock on March 1st. Your 180 days to get that gain into a QOF ends around late August.
Same 180-day clock, different starting trigger potentially, and the holding periods for the big benefits are long.
Very long. That 10-year hold is required for the tax-free growth benefit. That's a decade your capital is tied up in that specific QOF investment. Big impact on liquidity.
Less easy to get your money out if you need it.
Much less easy.
And the structure has to be a partnership or corporation QOF.
Yeah.
How does that affect things?
It means you're investing in the fund entity, not directly owning the underlying property like in many 1031s. This can sometimes mean less direct control for you as the investor. And again, a simple single-member LLC taxed as a disregarded entity generally doesn't work for the QOF itself unless it elects different tax status.
What about using debt or leverage? Is that as easy as with a 1031 property?
The sources suggest it's more limited. How debt works inside a QOF partnership or corporation structure is different. You often can't just refinance the property itself easily and pull cash out the way you might with a directly owned 1031 property. Debt might be tied more to your equity stake in the fund. It limits leverage options.
Okay. And is there QI involved, someone holding the money?
Nope. No mandatory qualified intermediary like in a 1031. You typically invest directly into the QOF, dealing with the fund sponsor. You report the investment on your tax return using Form 8997. The QOF itself has reporting duties to the IRS too.
So, more direct, but maybe riskier if the sponsor isn't solid.
That's a point the sources raise. Since OZ is newer, some fund sponsors might not have the long track record of established QIs. Due diligence on the sponsor is really important. Who are these people? What's their experience, especially with development in potentially tough areas?
And because it's newer, less legal certainty, more political risk.
Definitely. The IRS is still issuing guidance clarifying the rules. One source estimated OZ law is maybe 60–70% settled compared to 1031 being like 95% settled. Plus, it was part of that partisan 2017 tax bill.
Right.
So it faces political headwinds. Critics worry it's just a giveaway to the rich without enough community benefit. While a retroactive repeal is unlikely, future changes or whether it gets extended past its current sunset dates. That's less certain than the century-old 1031 rules.
Okay, let's sum up the potential downsides or challenges for OZs then. The deferral on the original gain is only temporary tax is due by end of 2026.
Yep.
Big benefits require really long holding periods, like 10 years. Investment is pretty much limited to development or major rehab projects because of that substantial improvement rule.
Right, less flexibility there.
Less liquid, harder to use debt the same way as 1031.
Limitations on leverage.
Potential sponsor risk, more legal and political uncertainty. And you mentioned no step up in basis at death for the QOF investment itself.
Correct. That's a key difference from 1031. Your heirs wouldn't get that basis step up on the QOF shares.
Plus, state and local taxes might still apply.
Yeah, state conformity varies.
Okay. Complex stuff. Benefits are there, but definitely need to navigate those hurdles carefully.
Absolutely. It's not a simple plug-and-play strategy.
All right, we've explored 1031. We've explored OZs. Now for the main event. Let's put them head-to-head. Contrast the key features directly, based on our sources, to really hammer home how different they are.
Yeah, the side-by-side really clarifies things. They both offer tax advantages, sure, but they're built for fundamentally different scenarios.
Okay, let's start with the big one. Duration of the tax deferral on that initial gain.
Huge difference here. 1031 exchange, potentially indefinite deferral. Keep exchanging, keep deferring, potentially until death when the gain might be wiped out by the basis step-up.
Indefinite possible elimination. OZ.
Opportunity zone, strictly temporary deferral. Tax on that original gain is due when you sell the QOF stake, or December 31st, 2026, whichever comes first. No ifs, ands, or buts.
Okay, what about growth after the initial investment, the appreciation on the new property or QOF stake?
In a 1031, that appreciation just adds to the deferred gain. It rolls forward, still deferred, until a taxable sale, unless eliminated at death. With OZs, this is where they shine if you hold for 10 plus years. That new appreciation on the QOF investment itself can be 100% tax-free.
So 1031 defers the new growth. OZ potentially eliminates tax on the new growth after 10 years.
That's the trade-off.
What about the source of the gain you're deferring? Where did the money come from?
Another massive difference. 1031 must come from selling investment or business real property. You swap real estate for real estate.
That's it, OZ.
OZ gain can come from selling any appreciated asset, stocks, bonds, business, collectibles, crypto, or real estate. Much wider net.
Okay. And how much money do you have to reinvest?
1031. To fully defer, you must reinvest all the proceeds, the full value, including debt. No pulling cash out easily without tax consequences. Boot.
All in, OZ.
OZ. Generally, you only need to reinvest the gain portion of the proceeds. You can often take your original investment basis back out tax-free.
Oh, interesting. So more potential upfront liquidity with OZ if you just roll over the profit.
Potentially, yes. If you sell something for $1 that you bought for $200, you might only need to invest the $800 K gain into the QOF and could maybe keep the $200 K basis. With a 1031, you'd need to reinvest the full $1 in value.
Got it. What about geography and asset type for the new investment?
1031 can buy like-kind real estate anywhere in the U.S. Broad geography, flexible property types, land, commercial, residential rental, etc. doesn't require improvement.
Flexible. OZ.
OZ must invest in QOZ property or businesses within specific designated zones, geographically restricted, and strongly favors development or substantial improvement due to the rules.
So 1031 is location flexible, OZ is location specific and development focused.
You got it.
How about using debt? Leverage.
1031. Generally easier to replace debt on the property itself, more straightforward refinancing options later, though cash out refis have their own tax implications.
Okay.
OZ. Debt is handled within the fund structure, often tied to the equity interest, generally more limitations on leverage and refinancing compared to direct property ownership.
Intermediary requirement.
1031. Requires a qualified intermediary, QI, as a safe harbor to hold funds. OZ, no QI required. Investment goes into the QOF taxpayer report.
Estate planning. Step up in basis at death.
1031. Potential step up in basis at death, possibly eliminating deferred gain. Big benefit. OZ. No step up in basis at death for the QOF investment. Heirs inherit your basis.
And finally, legal certainty and risk.
1031. Very mature, settled law. Over 100 years old. Low legal political risk currently. OZ. Newer law, still evolving guidance from Treasury, carries more political risk due to its origin and ongoing scrutiny.
Fantastic breakdown. It's crystal clear they serve different purposes and different investor profiles. Which leads us right into the next big question. Can you actually use them together? Can they overlap?
Yeah, this is where it gets really interesting and potentially tricky. The short answer is yes, in some very specific, limited ways, but definitely not in some of the ways people might first assume.
Okay, let's hear the yes scenarios first. How can they work together? I think you mentioned something about a failed 1031 potentially rolling into an OZ.
Yes, that's probably the most common scenario where they can connect, kind of like a plan B. So imagine you start a 1031 exchange, sell your property.
Clock starts ticking.
Right. You're in your 45-day identification period. But maybe you just can't find a replacement property you like, or maybe the deal falls through, or you just change your mind before day 45 is up.
Okay, so I either formally bail on the 1031 within 45 days, or just let the deadline pass without naming anything.
Exactly. If you tell your QI, I'm out, or if the 45 days expire with no valid ID, the QI is then required, under the rules, to release the funds back to you. Usually happens right around day 46.
So I get my cash back from the QI. Now what? How does OZ come in?
Here's the key. Remember that 180-day clock for investing gains into a QOF. It started on the same day as your 1031 clock the day you sold the original property.
Both clocks started at the same time.
Right. So if your 1031 fails and you get your money back on day 46, you still have the rest of that original 180-day period, roughly 134 more days, to take the gain portion of that cash and invest it into a QOF.
So the failed 1031 cash can fund an OZ investment if there's still time left on the 180-day OZ clock.
Precisely. You pivot, You salvage a tax deferral, at least temporarily until 2026, for the gain via the OZ rules. Quick caveat, though. This generally doesn't defer depreciation recapture tax from the original property sale. That's likely still due.
Okay, so it's a potential fallback, but not perfect. Still, good to know it's possible. What's another way they might interact? Something about using a 1031 property within an OZ.
Yeah, this one's more complex, a multi-step process outlined in the sources. It involves using a regarded entity like a partnership or corporation, not a disregarded single-member LLC.
Okay, it needs a specific entity type. Step 1.
Step 1. The regarded entity does a normal 1031 exchange. Sells property A, buys like-kind property B, follows all the 1031 rules and timelines. Let's say property B happens to be located inside an opportunity zone.
So standard 1031 into an OZ property.
Right. Step 2. After the 1031 is totally done, the entity now elects to be treated as a qualified opportunity fund, QOF.
The entity owning the property becomes the QOF.
Exactly. Step 3. New money comes into this QOF entity. Could be from the original owners putting in fresh cash, or maybe they syndicate it, bring in outside investors' capital gains into their newly formed QOF.
Okay, new cash comes into the fund. Step 4.
Step 4. The QOF uses this new money to substantially improve property B, the one it acquired via the 1031. Remember that substantial improvement rule?
Right, got to spend as much on improvements as the building cost.
Yep. So what's the result here? The original gain deferred from the 1031 exchange on property B. That stays deferred under the 1031 rules tied to the property's basis.
Okay, 1031 deferral is preserved.
And the new money that came into the QOF and was used for the substantial improvements. That investment is now eligible for the OZ benefits, including the potential 10-year tax-free growth on its appreciation.
Whoa, so you're layering, keeping the 1031 benefit on the acquisition and getting OZ benefits on the new improvement capital.
That's the idea. It's complex, definitely need expert advice, but it's a potential structure described.
Very intricate. Is there maybe a simpler way to use both from a single sale?
Yes, a more direct approach is splitting the proceeds.
Splitting how?
When you sell your relinquished property, property A, you could structure it so that part of the proceeds go into a standard partial 1031 exchange. You use a QI for that portion, identify a smaller replacement property, property C, reinvest that part of the value, deferring gain on that slice.
Okay, partial 1031 for some of the money.
Then you take the remaining proceeds from the sale of property A specifically, the capital gain portion attributable to those remaining proceeds, and you invest that amount into a qualified opportunity fund.
Following all the OZ rules for that part.
Exactly. Within 180 days of the sale of property A, invest that gain into a QOF. The sources suggest you'd allocate the basis of property A proportionally between the 1031 part and the OZ part for calculating the gains.
So one sale could potentially fund both a smaller 1031 exchange and an OZ investment.
That's the concept. Lets you maybe keep a foot in the traditional real estate deferral world with the 1031, while also dipping a toe into the OZ development potential with the rest of the profit. Now, having said all that, it's super important to know what does not work. Getting this wrong means paying tax you didn't expect.
Okay, let's hear the warnings. What's the biggest don't?
The absolute number one thing you cannot do is try to do a 1031 exchange directly into a QOF as your replacement property.
So sell my building, tell the QI to buy me shares in an OZ fund.
Nope, won't work. The sources are crystal clear. An interest in a QOF, which is a partnership or corporation, is not considered like-kind real property under Section 131. End of story. That attempt fails the 1031 and the sale of your building becomes fully taxable.
Loud and clear. Cannot 131 into a QOF. What about that failed 1031 scenario again? Can I always use OZ as a backup if my 1031 falls apart?
Not always. It depends when it fails. As we said, if it fails early, before day 45, and you get funds back before day 180 from the original sale, you likely still have time on the OZ clock.
Right.
But what if your 1031 fails late? Say you identified properties, you tried to close, but the deal collapses after the 180-day exchange period has passed.
So day 181, the deal dies. The QI sends me my money back.
By then, your 180-day window to invest in a QOF, which started way back on the original sale date, has also closed. Those funds are now generally too late to qualify for OZ investment. Timing is absolutely critical.
So a late 1031 failure likely means you missed the OZ boat too.
Generally, yes. There's a narrow technical exception for certain types of gains, Section 1231 gains, where the OZ clock might start later, but for typical capital gains, the clock starts on sale day.
Okay, and trying to somehow force the QI to give me money early if I think my deal might fail, Bad idea.
Extremely bad idea. The sources warn against trying non-safe harbor maneuvers to get funds prematurely from a QI if you've already identified property. If you do that and the 1031 fails anyway, you've likely blown the exchange and could face penalties from the IRS for violating the rules. Stick to the established procedures.
Got it. Follow the rules, especially with timelines. Wow, this has been a seriously deep dive into two really powerful but very different strategies.
It really has. And it shows how the tax code tries to achieve different things, right? The 1031 is all about that continuity of investment in real estate itself. Indefinite deferral, flexibility across the U.S., potential estate benefits, good for swapping assets, including stable ones.
Yeah, classic real estate play. And OZs are laser-focused on pushing new money into specific underserved areas.
Exactly. Offering that temporary deferrals for gains from any asset, needing only the gain reinvested, but then dangling that big prize of tax-free growth on the new investment if you stick around for 10 years and embrace the development or substantial improvement model in those zones.
So, wrapping this up for the listener, the big question is always, which one is right for me? And the answer seems to be.
It completely depends. There's no single better strategy. You have to look at your situation. What are you selling? Real estate only or other assets? What's your main goal, indefinite deferral or potential tax-free growth on new capital via development?
How much risk can you handle? Development risk versus just owning property risk.
Right. How long can your money be tied up? 10 plus years for OZ benefits is a long time. Are you looking to buy something stable? Or are you ready to build or do a major rehab?
Answering those personal questions is step one.
Absolutely.
And given how complex both of these are, especially trying any combined approach, getting professional advice seems less like an option and more like a necessity.
Oh, 100%. Non-negotiable. The rules for both 1031s and OZs are incredibly detailed. Mistakes are easy to make and can be very, very expensive in terms of unexpected taxes and penalties. Talk to qualified tax advisors, legal counsel, financial advisors who really understand these programs before you do anything.
Good advice. One thing that struck me listening to all this is how these aren't just random rules. They have purposes. 1031 aims to keep capital flowing within real estate. OZs aim to revitalize specific communities. Understanding that intent behind the law might help you figure out which strategy aligns better, not just financially, but maybe with the kind of impact you want your investment to have.
That's a really insightful point. The tax benefits are the mechanism, but they're driving towards broader economic goals. Aligning your personal goals with those policy goals can be part of the decision.
So thinking about those trade-offs,
Yeah.
here's a final thought for everyone listening to chew on. That hard deadline for the OZ tax, December 31st, 2026, when your original deferred gain comes due. How does knowing that specific date influence your thinking compared to the potentially limitless deferral of a 1031? Is the lure of maybe getting tax-free growth on the new OZ investment after 10 years, knowing it involves development, and that long hold truly more appealing than the flexibility, certainty, and estate planning power of just deferring the gain indefinitely with a 1031?
It really forces you to weigh current tax certainty versus potential future tax benefits tied to specific actions and timelines. A fascinating calculation.
It is indeed. There's always more to learn, more to unpack in this complex world of investment and taxes.
Always, never stops.